When would you use the sales comparison approach to determine value? This method is used every day when valuing residential property. The core principle is that a property, let's say your single-family home, the subject property, is worth approximately the same amount as what other similar homes, also known as comparables, have sold for recently in the area. For example, the home next door to you recently sold for $200,000. Assuming it wasn't a foreclosure or duress sale and your home is virtually identical, then your home is worth around $200,000. Of course, using only one reference point could skew the data. Therefore, a normal appraisal would reference at least 3 sold properties while numerically accounting for any differences between the homes in question. The results would be averaged or reconciled to provide the final estimate of value. Let's look at a quick example of how numbers would be adjusted. The home next to you is identical to yours with the exception that it has a 3-car garage and your home only has a 2-car garage. In this example, your neighbor's home is slightly better, i.e., worth more money because it has a larger garage. If your neighbor's home sold for $200,000, your home would sell for slightly less. So, if the appraiser determines that the additional present value of an extra 1-car garage in your area is $10,000, your home might be appraised at $190,000. That is, $200,000 minus $10,000. One easy way to remember this is CBS. If the comparable is better, then you subtract because we're trying to figure out what the subject property is worth. In essence, we know that the original sales price needs to be adjusted to account for any and all physical differences between the homes. It works just the opposite if your home is better than the comparables. In that case, you would add an amount on top of what your neighbor's home sold for to arrive at an estimate of value for your home. Where are these comparables found? How do appraisers choose which ones to use? They have to sift through all of the sold information and organize the properties, choosing the ones that are most similar and those that have sold more recently. Most appraisers are members of the same multiple listing services that real estate agents belong to, so they can access currently listed and sold information online. They can also reference any other public information available to them at the recorder's office or courthouse. Using the two together would give a more accurate account of all property that was listed and sold, including for sale by owners. Remember, the more up-to-date and comprehensive the information, the more accurate the appraisal is likely to be. The second type of valuation method, the cost approach, is better suited to unique properties like schools or churches. Properties such as these are seldom rented or rarely sold, so the total cost to reconstruct becomes the most important method when appraising current value. The appraiser would start by separating the land and the structures so a unique value could be placed on the land. They would then determine what it would cost to rebuild the structure using today's prices. While different methods exist, the easiest and most commonly used way is the square footage method, where averages for the community are multiplied by the total square footage. For our example, we'll keep it simple, but garage space or basement square footage would be treated uniquely, as each would have a different cost to build. Let's say a building is 2,000 square feet, and the average price per square foot to build it today is estimated at $100 per square foot. Don't get hung up on the price per foot because this changes over time and depends on costs in your community. But, using our numbers, the cost to replace the building would be 2,000 square feet times $100, or $200,000. Unless the building is brand new, an adjustment would need to be made for depreciation of certain items such as the roof, the heating and air unit, the carpet, etc. In these cases, the appraiser would deduct the total accumulated depreciation. There are different ways of determining the existing depreciation which go beyond the scope of this explanation, but for argument's sake, let's assume a depreciation rate of 10% for this 5-year-old building. The current value of the structure, as it sits today, would be $200,000 minus 10%, or $20,000, which results in a building valued at $180,000. At this point, The appraiser would add back in the value of the land, which would be included in any sale. Let's say it's $50,000. So the current value of the building and land would be $180,000 plus $50,000, which is $230,000. Separating out the land and adding it back in can be confusing, but there's a good reason why it's done. Land is not depreciated because it will always be there, assuming no mudslides, whereas any man-made structure has an estimated lifespan. The economic life is the time period that the appraiser determines the property will continue to be useful for its intended purpose, which in turn helps them determine current depreciation. If depreciation seems subjective to you, then you'll probably like the final and very straightforward income method of estimating value. The income approach to value is commonly relied on heavily when trying to determine a value for rental properties. Since investors are all about making a return on their investment, they prefer verifiable documentation they can use to determine a reasonable value. This is accomplished using a formula commonly referred to as ERV. The yearly net income of a property divided by the desired rate of return would result in a suggested value. If a building's rent for the entire year is $24,000, $2,000 a month, and the investor wants a 10% rate of return, sometimes referred to as a capitalization rate, then the building has a value to that particular investor of $240,000, $24,000 divided by 10%. There is an inverse relationship to value and the desired rate of return, so the greater the desired return, the less the investor could pay for the building. If they wanted a 20% rate of return, the building would only have a value to them of $120,000. That's $24,000 because the income remains constant, divided by 20%. In these calculations, it's important to remember that income is net income, not gross income. This method can require some number crunching because there could be expenses and potential vacancies or credit losses, tenants not paying their rent, which would reduce the actual net income an owner would receive. If this math is making your head spin, here's a substitute method that's sure to make you smile. It's a shortcut method that might be used for properties that would not necessarily be purchased exclusively for income, such as a single-family home in an owner-occupied area. It factors in rental income, but not expenses. It's called the gross rent multiplier, or GRM, and it's nothing more than a relationship between value and rental income. The appraiser would determine the possible monthly rent and multiply it by the GRM for the area. This would result in the projected value. If the GRM is 100 and the property would rent for $2,000 a month, according to this approach, its approximate value is $200,000. $2,000 times 100. You may be asking yourself, where does the GRM come from? That's an excellent question. It is generated by what other properties have sold for in relation to what they rent for. So, if the home down the street sold for $250,000 and rents for $2,500 a month, assuming this was consistent with other properties, the GRM for the area would be 100, $250,000 divided by $2,500. In other words, the value of homes in this area is 100 times the monthly rent. Many old-time investors have used this method for years. They just don't know what it's called. They simply multiply the rent they projected by 100 to determine the value. Therefore, a home that could rent for $500 a month is worth $50,000. A home that could rent for $600 is worth $60,000. Each of the appraisal methods has its own pluses and minuses, depending on the situation and type of property being appraised. While they each are best suited to a specific type of property, in reality, the appraiser will use at least two of the three approaches on every property to confirm the value as best they can. If it's a single-family home, the appraiser will pay more attention to comparables. They may also calculate the value via the income approach and/or the cost approach to confirm what they discovered when viewing the comparable sales information. The term reconciliation is used to describe taking all of the methods and numbers used to ultimately arrive at the final number that serves as an estimate of value. It seems like a lot of work, and everyone is still going to argue over it regardless of what the appraiser says.